Welcome to the presentation. We're going to talk today about how reverse mortgages can introduce a financial solution to divorce. A lot of stuff going on right now with the economy, inflation, rising interest rates. Some of those topics were touched on during the last presentation. We're going to get into some solutions today using what is, in most cases, your client's largest asset other than their business, which was mentioned in the last presentation, and that's the equity in their home. So before we get started, I do kindly ask that you hold your questions until the end. I've carefully crafted this presentation to hit on a lot of key questions that do tend to come up. I do a lot of these presentations, so it's typically the same questions that come up, but feel free to mention anything in the chat that you'd like. I'll be glancing over from time to time. And then at the end, we'll get into some Q&A. Let's talk about why we are here today. There has been a lot of talk of late about rising inflation, soaring cost of consumer goods, $6, $7 a gallon gas in a lot of different states, and folks that are retired or those that are heading into retirement. For them, the risks and stakes are high, right? How do they live a comfortable retirement with financial security and peace of mind, particularly with inflation that is creeping up in the double-digit mark? This could have major sequence of return risk and may result in reducing the longevity of your clients' investment portfolios, putting them at greater risk to outlive their money. And for some, this could mean having to remain in the workforce far into their golden years, or they may be forced to make lifestyle changes and sacrifices to stretch retirement savings and assets. However, there is an unprecedented level of housing wealth, right? For folks that are 62 plus, a recent report published stated that these folks have over $11.2 trillion in untapped housing wealth. So while they're struggling, looking at their retirement statements, wondering why they're not seeing the gains that they've seen in recent years, they're wondering, are they going to be able to retire? What are they going to do once they go on a fixed income? And what do they do in the unfortunate circumstance of divorce? Divorce rates among baby boomers is at an all-time high, right? That's no secret to all of you on this webinar presentation today. You know this, you're in this world. So what I want to talk about today is how this $11.2 trillion with a T, trillion dollars in untapped equity can provide solutions for your clients. So over the next hour, we're going to be talking just about that, how your clients can leverage what is in most cases their largest personal asset, their housing wealth, in a variety of different ways using a reverse mortgage loan. And as we move on, here's a few stats to consider. And some of these are really, really alarming. Divorce rates among those 50 plus has doubled since the 1990s. And divorce rates for those 65 plus has tripled since the 1990s. 74%, of all retirees are on pace to fall short of their retirement income needs by the age of 62. 74% of these people. 70% of these folks will require some level of long-term or extended care in their lifetime. In 2019, I got my CLTC designation. Now, I do not sell long-term care insurance. I got the designation to have a deeper and a better understanding of what the cost of long-term care is, to be able to discover stats like this. 70% of people will require long-term care. And I also learned that less than 3% of these 70% are protected with long-term care insurance. Reverse mortgage can be a great solution to help fund a long-term care insurance policy. We're going to get into that a little bit later on in today's presentation. And folks, again, there is over $11 trillion in untapped equity. This equity, particularly with rising inflation and the soaring cost of consumer goods, this equity is going to be key to your clients living a more comfortable lifestyle. So what is in store for all of you here today? Well, we're going to talk, number one, about reverse mortgage basics. And finally, Finally, you're going to have a better understanding. You're going to gain a better understanding of how reverse mortgages really work. We're also going to talk a lot about the evolution of reverse mortgages. These are products that have evolved and changed quite a bit over the years. We're going to talk through some housing wealth concepts and strategies to help your client navigate gray divorce or silver divorce, whatever they're calling it these days. We're going to talk about the variety of reverse mortgages. There's a lot of different types of reverse mortgages. We'll cover all of those here today. We'll close with some myth versus reality, some fact and fiction, and hopefully a very lively and interactive Q&A session. All right, what you're going to leave with is this. You're going to gain a better understanding about how to optimize your client's retirement by interjecting housing wealth into the equation, right? Something that we do here at PRMI is we look at reverse mortgages, I think, a little bit differently than a lot of other mortgage lenders. We're looking at this as part of an overall comprehensive retirement income strategy. And for a lot of you that are fiduciaries, or even if you're not a fiduciary, right, is it prudent in today's market, in today's environment, this climate that we're in, to overlook your client's largest asset, which is, in a lot of cases, the housing wealth, the wealth in between their four walls that currently may be locked? We're going to talk about ways to unlock that equity with a reverse mortgage. You're going to get answers. You're going to get a lot of answers. Now, I encourage you, ask a lot of questions to get these answers. But hopefully you're going to leave here today getting answers to your most burning questions about reverse mortgages. And you will become empowered. You're going to become empowered to take the information that you're learning today in my session and all of the other sessions that IDFA is bringing to you today and put this to work right now for the benefit of your clients. Okay, here we go. We're going to talk about some reverse mortgage basics. Number one, if you haven't heard the acronym HECM or HECM, that stands for Home Equity Conversion Mortgage. That is the FHA government reverse mortgage. Now, we're going to talk about some other types of reverse mortgages in a few moments, but what the heck is a HECM? Well, a HECM, a Home Equity Conversion Mortgage, is just another way to say reverse mortgage. These loans are insured by the federal government, specifically by FHA, with federal oversight by a lot of different government regulatory agencies. We have FHA, we have HUD, we have FDIC, we have CFPB, and all the other state municipalities out there. Minimum age requirement on HECM, on the government variety of reverse mortgages, is 62. However, now we can lend a reverse mortgage loan to folks that are 55 plus. You see, now we have proprietary reverse mortgages to offer our clients, non-FHA, non-government. These are private label reverse mortgages. They still have all the same safeguards and protections as the government mortgages do, but a lot of private mortgage lenders have stepped into the arena now, and they've come up with products that rival, and in some cases are even better, lower cost options than the HECM government insured version. With reverse mortgages, a borrower, I think a general rule of thumb is that a borrower can access roughly 50% of the equity in their home. Later on in today's presentation, we're going to talk about a variety of payout options for them to actually receive those funds. There are no mandatory mortgage payments with reverse mortgages. Reverse mortgages come with a flex pay option, both the HECM government insured variety and the proprietary reverse mortgages come with a flexible pay option. Well, Steve, what does that mean? A flex pay means just that. The borrower can choose whether they want to treat their reverse mortgage no different than a traditional mortgage loan. They can make payments, if they want to, of any denomination at any time, and there's no prepayment penalty. We have a lot of clients that make interest-only payments because they need some relief. They maybe can't afford, or they're worried about, will they be able to afford later in life paying principal and interest? So they choose to pay interest only. The idea behind that is they're trying to keep their mortgage balance from going up. If you defer, if the borrower, I should say, defers to make payments, that would-be payment is added to the back of the loan. Now, over the past 3 years, what COVID-19 has taught much of America is the concept of deferment, right? How many Americans? A lot have been in some type of mortgage deferment program since the onset of COVID-19. And that was these lenders' way to provide some relief. Reverse mortgage, think of reverse mortgages as a permanent deferral program with the option to make a monthly mortgage payment. And that allows your client to be in control, right? They can choose if they want to make payments and keep their balance down, or if it works better for them and their lifestyle, they can choose to forego making monthly mortgage payments. But there is no mandatory mortgage payment, freeing up cash flow for them to live more comfortably with more peace of mind later in life. And here's something that I still hear in 2022. It shocks me that I still hear this, but we get asked all the time, Steve, is the government going to take my home? Right? Is the lender going to take my home? Unequivocally, the answer is no. The borrower owns their home. A reverse mortgage is just that, folks. It's just a mortgage loan, right? It's a mortgage loan, however, that provides better liquidity, better accessibility, and better flexibility. It's all about the flexibility, but never does the government, never does the lender own the home. The borrower always owns the home. Moving on, let's talk about the evolution of reverse mortgages. I mentioned these loans have changed quite a bit. Boy, have they. I've been in reverse mortgages for almost 17 years now. I truly cannot believe it's been that long. In the mortgage business, 17 years is like 700 years, right? There's a reason why I don't have a lot of hair left on the top of my head. Somehow it's all made its way to my face. But these loans have changed quite a bit for the better. The first reverse mortgage was originated in 1961. 1961. The federal government became involved in 1987. There was a lot of reverse mortgages taking place. There was no federal oversight at all. These were private reverse mortgages at this point, mostly given by local banks and lending institutions. So in 1987, during the Reagan administration, the federal government became involved and they started to back and insure reverse mortgages. Prior to 2015, however, reverse mortgages were misused and often misrepresented. Right. So now we're going to talk about why reverse mortgages have this negative, visceral reaction. You know, I call it the scarlet R. Whenever I talk about reverse mortgages, it's like I have a scarlet R on my chest. Reverse mortgages. Whoa. You know, isn't that loan that they take your home? The reason behind that is very easy. Number one, and comment in the chat. Who can remember the late night TV commercials with former Hollywood stars or Hollywood stars whose flame had kind of flamed out a little bit, I should say? Can anybody name some representatives? Who has pitched reverse mortgages over the years? I'm looking at the chat right now. Let's get some interaction from the virtual audience here. I'm not seeing anything. Can somebody chime in? Here we go. All right. Tom Selleck, of course, Tom Selleck. Joe Namath. Let's see, the Unsolved Mysteries guy. Who else? Alex Trebek. I don't think Alex Trebek did. I can tell you Fred Thompson, who was a former senator, Robert Wagner. Robert Wagner really he was the main pitch man for reverse mortgages. But the way that reverse mortgages were marketed to the community was as a loan of last resort. They were never designed to be a loan of last resort, ever. Right? They were designed to unlock some of the housing wealth that folks have accumulated for them to then turn around and use that housing wealth in conjunction with their other retirement assets. But never, ever were reverse mortgages intended to be for folks that were already broke. They were already destitute. But that's how they were marketed. Oh, no monthly mortgage payments, with no explanation as to how is that possible? Isn't that too good to be true? Right? I've been asked, is it too good to be true? Probably 10,000 times in my career. Folks, no, it's not too good to be true. It's a mortgage. Guess what? Has an interest rate, has a lien on title, right? No different than any other mortgage. It just gives better liquidity, accessibility, and flexibility. So prior to 2015, when the government stepped in again and came out with different new improved safeguards and regulations, these loans were used oftentimes as loans of last resort. And the people who took the loans out, by no fault of their own, right? They thought they were doing the right thing, but they failed to comply with the terms of the loan. What are the terms of the loan? You have to pay your taxes, you have to pay your homeowner's insurance, and you have to maintain the home because guess what? You own the home. It's your home. You always have to pay taxes. You always have to pay insurance. You always have to maintain your home. That's no different, folks, whether you have a reverse mortgage, a traditional mortgage, a HELOC, or guess what? No mortgage at all. But these folks that took the loan after they had already depleted their retirement savings and assets, after it was likely too late, right? They tried to put a Band-Aid on a gaping open wound, and they got themselves into trouble. Well, the reverse mortgage industry at the peak of foreclosure rate saw almost a 9% foreclosure rate, right? 9% of the people who were taking out reverse mortgages, and there was millions of people per year taking out reverse mortgages, 9% of those were foreclosed on, not because they had a reverse mortgage, not because the lending institution was shady or they did anything wrong, but simply because they could not comply with the loan terms. They were out of money. The reverse mortgage didn't give them enough money. Keep in mind, again, you can only take about 50% of the equity in the home with a reverse mortgage. You can't take 90, 95, 100% with a lot of other loans that are out there. And that's designed like that for a reason. So what happened? Well, a lot of these people went to the media and said, I had a reverse mortgage, and guess what? I got foreclosed on. And when the media reported on this, and they have an 80-year-old woman or a 90-year-old woman on the front curb of her home with a big foreclosure sign, they report woman has a reverse mortgage, or whoever it is had a reverse mortgage, and they lost their home, right? And that's where this visceral negative reaction that still happens today in 2022, that's where it originated from. Post 2015, let's go back for a second. Prior to 2015, if you were over the age of 62, you had equity in your home, and you had a pulse, right? You had blood coursing through your veins, you could get a reverse mortgage. There was no income check. There was no credit check. There was no ensuring through the underwriting process that the client can afford to pay the property taxes and they can afford to pay the homeowner's insurance. There was none of that. So that's the biggest change. 2015, we now have a financial assessment. Folks actually have to qualify. We have to look at their income. We have to look at their credit. We look at their property taxes. We look at all the parameters of the loan. We also look at suitability, right? I mean, is this loan going to help them accomplish the goals that they're trying to set forth to accomplish? There's been a lot more safeguards, more than I can even mention during today's presentation. A lot more regulation. These loans today, post 2015, have opened the eyes of the financial planning community. And now we have titans of the industry, so to speak, of the financial planning community, the Jamie Hopkins, the Wade Fowles, the Tom Hegnas, who all have done their own independent research and published white papers and reports and have done podcasts with me. Nancy Hetrick and I actually did a collaborative podcast with Jamie Hopkins, where we talked about reverse mortgages now, the new reverse mortgages, and how they're so beneficial to helping folks live a more comfortable retirement. And we're going to talk about later on today is how you, the CDFAs, can use these loans safely, reliably, and comfortably and confidently to help your clients to plan for a more comfortable retirement post-divorce. So now they're widely accepted financial tools. Now, we're not quite there yet. We're not quite to the point where they're mainstream, right? But we're getting there. My prediction is over the next 5 years, we're going to be there. We need your help, right? I'm here today asking for your help. After today's presentation, if you're somebody that's been down on reverse mortgages, if you still want to find out more, give us a call, give me a call. I'll fill in all the blanks. We'll talk through all the details. But if you can leave today's presentation and tell one person, hey, I heard a reverse mortgage presentation today, and you know what? They aren't these terrible things that most people think they are, right? And give us a call, and we'll help you. We'll help your client to plan and to make sure that reverse mortgages are a part of the plan, not just used as a loan of last resort. Because, boy, people are falling short. 74%, yeah, tongue twister there. 74% of retirees, we talked about this in a few slides ago, 74% of retirees will fall short of their retirement income needs by the age of 62. And that comes from Boston College Center of Research for Retirement, right? That's not a reverse mortgage report. There's independent studies out there that are pointing to this number, which is why I think it was really important to go over it with you here today. A storm is on the horizon, folks, especially right now. 10,000 people a day are turning 62, and that's going to continue to happen until the year 2030. We pointed out earlier, 70% of these folks will require some level of long-term or extended care during their lifetime. Healthcare costs continue to soar to the tune of $363,000 on average for the average healthy couple. What if they're not a healthy couple? Right? This is the average healthy couple. And the monthly average cost of unskilled home care is over $4,000 a month, and that's predicted to reach over $8,000 per month pretty soon by the year 2039. And again, less than 3% of people, of these 10,000 people per day turning 62 are protected with long-term care insurance. And boy, there's just an unbelievable amount of retirement risks. We have market risk. We have taxation risk, inflation risk. It's the topic that it's on everybody's mind right now. You can't turn on any news channel or financial channel on TV and not hear about inflation right now, because it is real. Withdrawal rate risk, particularly important for folks that are getting divorced, right? If your clients are folks that design their retirement plan on the average 4% withdrawal rate, and now they're going to divide assets and split assets, can they continue to draw that 4%? I don't know, right? You tell me. I don't know. What I do know is that there's massive withdrawal rate risk happening right now, particularly with inflation. Sequence of returns risk. I was talking to a client and their financial advisor the other day, and I asked a simple question. How much do you think, Mr. and Mrs. Client, can you take safely out of your investment portfolio without running the risk of outliving your money? You know what they told me? They told me 8%. And the financial advisor almost fell out of his chair. And the reality is, if they took 8%, they'd be out of money within 15 years. They're 65 years old. I mean, there's no way. And so I think people just need to be educated on, particularly right now in this market, withdrawal rate risk, sequence of return risk, and of course, longevity risk, which is, if anybody's familiar with Tom Hegna, what does Tom Hegna always say? Longevity risk is a multiplier of all of these other risks, because there is no number, right? There is no true retirement number. It's a moving target. Nobody knows how much they need in retirement because nobody knows how long they're going to live, right? Life expectancies are getting longer. People are living into their 90s and over 100 years old. But boy, this market is not helping them out at all. So we're going to talk today about the housing wealth solution, how to incorporate your client's largest personal asset to help them achieve a more secure retirement with increased liquidity, accessibility, and flexibility. And that's not the last time I'm going to mention those three things: liquidity, accessibility, and flexibility. That's what reverse mortgages are all about. So let's talk about some options, right? If you're working with a client, whether they're getting divorced or not, right? If their largest asset is their home, how can they safely, strategically, and tax efficiently use this equity? Well, number one is a cash out refinance, right? Everybody knows what a cash out refinance is. You've all done one, most likely. However, if you're working with a client, and let's say this is a divorce buyout situation, right? We see cash out very, very commonly with trying to split marital assets, particularly the home, which is in most cases their largest asset. So a cash out refinance to buy out another spouse so they can go their own way and the remaining spouse can stay in the marital home. Well, a cash out refinance is great. However, if you're working with a client that's 60 plus, a cash out refinance comes with a 15, 20, or 30-year mortgage term. And that comes with a mandatory mortgage payment. So from a cash flow perspective, a cash out refinance may or may not be the best option. A HELOC, everybody knows what a HELOC is, home equity line of credit. very common. You can go into your local bank, get one pretty easily these days. However, if we think back to 2007 through 2009, the last big economic downturn, particularly in the housing market, there was a lot of retirees that had big HELOCs that they relied on to live a comfortable retirement. And you know what? The bank suspended, reduced, or froze these lines of credit. The bank can do that whenever they want. There's no limits on when the bank can freeze a HELOC. And so is that the best solution? It also comes with a mandatory monthly mortgage payment. And with a cash out refinance or a HELOC, the borrower has to go through a debt to income ratio qualification. With reverse mortgages, we don't use debt to income ratio. We use RI, residual income. Our income calculation is simple. Do they have enough money coming in versus the amount of money going out every month to be able to comply with the loan terms? What are those loan terms again? They got to pay their taxes, they got to pay their homeowner's insurance, and they have to maintain the home. However, reverse mortgages don't have that mandatory monthly mortgage payment. There is no term. There's no 15, 20, or 30 years. So if you're working with clients, folks, and they're looking to liquidate the marital home, get money out of the marital home to then pay off one spouse in a buyout situation, and they're over the age of now 55, you should consider a reverse mortgage as a viable option. Let's take a moment and talk about some types of reverse mortgages. We talked about the biggest one, right? The HECM, the home equity conversion mortgage. That is the government, the FHA variety. We can also do a HECM for purchase. We're going to do a little case study later on when we talk about the HECM for purchase. A HECM for purchase allows folks to purchase their next primary residence with a reverse mortgage in one single transaction. What does that mean? Well, if you're working with a married couple and that married couple is obviously divorcing and they want to leave the marital home, maybe this isn't a circumstance where one spouse wants to remain in the home, or maybe even it is. The other spouse or both spouses can purchase their next home with a reverse mortgage. That looks like this. They got to put down about 50% on the next home. The reverse mortgage then covers the other 50%. So they can buy, let's say, a $400,000 home for $200,000 in cash with no mandatory mortgage payment, making this option a far better option from a cash flow perspective, a monthly outlay perspective, versus either buying the home in cash, right, and depleting that cash out of their investment portfolio, or being saddled with a monthly mortgage payment well into their 70s, 80s, and 90s. And now we also have proprietary non-government loans. Now, these loans can also be used for jumbo loans. We have a lot of jumbo loan clients right now, higher net worth clients. We can lend on these loans homes up to a $10 million value with loan amounts up to $3 million. So clearly, these loans are not loans of last resort. These are being used all the time by millionaires. Literally millionaires, because what do people that own these type of homes have in common? They understand the concept of leverage. It's how they built their business. They understand that all debt is not bad debt. And that's the concept of reverse mortgage, folks, right? It's debt. Absolutely, it's debt. But you leverage this debt strategically and tax efficiently. And we work with financial advisors in partnership with them to just be a piece of the puzzle. It's all housing wealth is, right? It's a piece of the puzzle. It's a piece of the overall retirement equation, but it does represent, in most cases, your client's largest asset. And so if you're looking at ways to divide assets, divide the housing wealth, or if spouses are looking to move on and purchase their next primary home, you should consider a reverse mortgage, strongly consider a reverse mortgage as another viable option. Let's talk about some payout options. We got a few more slides to go, and then we will open it up to some Q&A. The first payout option is this. What we see most commonly is we pay off and replace a traditional mortgage loan. We replace it with a reverse mortgage loan, freeing up that mandatory monthly mortgage payment obligation. You can also access funds as a 10-year Think of a tenure as an income annuity being paid out by the home, where the client receives a check each and every month for life. Term payouts. We see this most commonly with Social Security deferment. I believe this came up during the last presentation, the concept of deferring to receive a higher Social Security check. We work with a lot of clients, most of them referred to us by financial advisors, who want to bridge that gap, right? They're trying to delay their Social Security. They're trying to wait to turn it on as late as they can, but they need income, right? So if your client's 65 years old, they're trying to get to 70, we can turn on funds to be paid out from the house for 5 years. You can turn it on for 10 years, 15 years. It's a fixed monthly payout given to your client each and every month. But most commonly, we see that used for Social Security deferment. A lump sum. We see this most often with retrofitting the home, turning the home into a home that is more conducive for your client's long-term lifestyle needs. They can just take a lump sum, do repairs to the home, do upgrades to the home, pay off debt, debt consolidation. That would be a good usage of a lump sum. A line of credit. And this is the secret sauce that not many people know about. Did you know a reverse mortgage line of credit comes with a guaranteed rate of growth? Guaranteed rate of growth. It's not interest. It's not interest earned. Think of it like a credit card, and your credit card company is increasing your limit, your borrowing power each and every year. Reverse mortgages work just like that. The growth rate is 0.5% over the interest rate on the loan. So a lot of people that have reverse mortgage line of credits right now, they are cheering, they're rooting for interest rates to go up, because as interest rates go up, so too does the available funds in their line of credit. And you can customize all these payout options. What we do here at PRMI is we sit with our clients, we sit with our advisors, we take a very slow approach. Number one, we need to determine suitability. We actually turn away about 25% of the clients that come to us asking for a reverse mortgage, because through our discovery, we determine they're just not suitable. If they are suitable, however, we're going to work with them to customize these payout solutions. For instance, maybe we're going to pay off their existing loan, free up that cash flow, and we're going to turn on a term payout to bridge the gap so they can delay Social Security. Or maybe we're going to turn on a monthly income stream through a tenure where they're receiving a guaranteed check every month, and we're going to open a line of credit that they can draw if and when they need it. These are the most customizable, flexible, again, it's all about flexibility, loans on the market today. Here's the buyout scenario. We're going to go through this pretty quickly because we are a little short on time. William and Rose, we disguised their names. Obviously, these aren't our real clients' names, but this is a real life scenario. William and Rose were in their 60s. They chose to divorce. They can't even look at each other on the bench. They've been together for all these years. They can't even turn and look at each other. Can you believe that? Their home is valued at $500,000, fully paid off, free and clear. William wanted to continue to remain in the home, while Rose preferred to purchase another one. Instead of selling the home, the couple explored a refinance. However, William didn't think he could afford the monthly mortgage payment. He's on a fixed income. He's a little bit older, right? He doesn't want to be saddled with that monthly mortgage payment later on into his life. He then discovered that a reverse mortgage would be a better option through chatting with us and learning and becoming empowered and educated, through which he would receive about 50% of the home's value. He then used those funds to buy out Rose's interest in the home. And Rose went her way. William went his way. It was the perfect scenario. Let's talk about some realities. I'm going to bring all of these up here. There's a lot of myths. There's a lot of myths with reverse mortgages. I want to kind of take a moment to dispel some of these myths and realities. Number one, interest rates are on par with traditional mortgages. Some of the feedback we get is, well, Steve, sounds good, but I've heard reverse mortgage interest rates are exorbitant. They're not. No different than traditional mortgage rates. Today's rates, around 6% on a reverse mortgage. The bank does not own the home, folks. We cleared that up. I hope that none of you still believe that the bank or the government or anybody other than the homeowner owns the home. Reverse mortgages should only be used as a last resort. That is an old school, old guard way of thinking. I would encourage you Look up Wade Fowles' research. Look up Jamie Hopkins' research. These aren't people in the reverse mortgage space. These are retirement researchers that have put in the work, published the white papers on how and why reverse mortgages should be used in your client's retirement. Borrowers, heirs, and the estate are not past a debt. These are non-recourse loans, meaning that if your client takes out a reverse mortgage and they choose to never make a monthly mortgage payment, they defer all the payback. Well, we're in a downward housing market right now. What if they wind up owing more on the value of, more on the balance of their loan than the value of the home at the time that they pass away? The heirs and the estate are not personally liable. These are non-recourse loans, giving your client the peace of mind of knowing that they will never, ever pass on a debt to their heirs that the sale of the home simply can't satisfy. And for those of you who don't know, independent HUD counseling is required on every reverse mortgage, regardless whether it's a HECM government loan or a proprietary loan. There's always a third-party counselor involved. That counselor's duty, their responsibility is to make sure that cognitively the client, because these are older folks, that they can make a well-informed financial decision, that they are working with a licensed and reputable mortgage lender, and they're there as an uninterested third party to answer questions. Here's another real-world scenario. Home buying in reverse. Robert and Sharon, they grew apart after 20 years of marriage, and they agreed to separate amicably, thankfully. After splitting the value of the home, there was not enough money to purchase a new home. On a fixed income, it would have been difficult for Sharon to qualify for a traditional loan, again, because traditional loans use a debt-to-income ratio, not residual income like we do. So Sharon put down 50% from the equity of the sale of the marital home, the departure home. The balance was financed with a reverse mortgage. She bought her new home using a reverse mortgage loan. She put down the loan. Sorry. PowerPoint's taking a little bit long to load on my end. I don't know if you're having difficulties on your end. Anyways, my slide is frozen. I hope yours isn't. Anyways, she purchased her next primary home in one single transaction using a reverse mortgage. And moving forward, she does not have a mandatory monthly mortgage payment. She simply needs to pay the taxes, the homeowner's insurance, and maintain the home. This allowed both parties to move forward with their divorce without leaving one holding the short end of the stick. And the whole reason that I'm here presenting to you today is that we are changing the conversation. I hope that today's presentation allows you to change the conversation, change the way you think about reverse mortgages, change the way perhaps you engage with your clients regarding the conversation around using housing wealth and incorporating that housing wealth into a more holistic, comprehensive retirement plan. That's what it's all about. And with that, folks, I thank you so much. And let's open it up to some Q&A.
Awesome. So let's see. What is the advantage of a, sorry if I say these wrong, maybe HECM over a HELOC in a repayment situation?
I mean, the HECM, the reverse mortgage is going to, there's no mandatory monthly mortgage payment. In addition, a HELOC, like we mentioned, a home equity line of credit, can be suspended, reduced, or frozen. A reverse mortgage line of credit cannot. Federally insured versus not federally insured. So if you take out a reverse mortgage line of credit, not only is the growth rate guaranteed, your line of credit, the client's line of credit, is guaranteed, where it's not on a traditional HELOC.
Are the fees much higher than a conventional mortgage? That's certainly what we hear.
Yeah. So on a proprietary loan, absolutely not. The government loan, the fees are higher, mainly just because of the mortgage insurance premium. The mortgage insurance premium is 2% of the appraised value of the home. It's paid directly to FHA to insure and guarantee the loan. It also guarantees the non-recourse element, right? So it's a little bit higher barrier to entry, cost of entry versus a traditional loan. But I think, at least part of what we do is we weigh the options between a proprietary private reverse mortgage and a government reverse mortgage to help you and your client decide which is more advantageous.
All right. Can you use a reverse mortgage to purchase a second home?
You cannot. No, it has to be a primary residence. Great question.
All right. When and how are reverse mortgage loans paid off?
Reverse mortgage loans are paid off no different than a traditional mortgage loans, right? So when you die, the home goes to the heirs, right? No different than a traditional loan. The heirs can then pay off the reverse mortgage, or they can decide to buy out the reverse mortgage. If they sell the home, which is the most common, they sell the home through the proceeds of the sale, the reverse mortgage loan is satisfied with any remaining equity going to the heirs as part of their inheritance from the housing wealth.
All right. And then somebody asks if you could explain what are suitability considerations.
Yeah, it's a great question. So the question that we always ask every single client, how long do you want to live in the home? Particularly if they're looking at a HECM, the government reverse mortgage, because the closing costs are a little bit higher on these loans. If the answer is anything less than 5 years, oftentimes we're going to advise them to look at an alternative solution. Reverse mortgages are meant to be long-term retirement planning solutions, not a Band-Aid on an open wound, not a quick fix. So as far as suitability, right, what are their goals? Can we help them accomplish their goals? The answer may be no, but the first question we always ask is how long are you looking to live in the home?
Perfect. I heard you say clients must be age 62, but I also heard you say a reverse mortgage should be considered if they're 55 plus. Can you clarify?
Yeah, so the HECM, the government variety of reverse mortgages, the minimum age requirement on those loans is 62. But now, like I mentioned during the presentation, now we have private reverse mortgages, non-government reverse mortgages. The fees are a little bit lower on those loans. And we can lend down to age 55 in most states. These aren't available in all states yet, but they are in most states. And the minimum age requirement on those loans is age 55.
All right. And then how are higher interest rates impacting reverse mortgages?
Yes. So our borrowers are typically not rate sensitive because there's no mandatory mortgage payment, right? So a rise in interest rate doesn't result in payment shock to the borrower. What does happen with a rising interest rate environment is less proceeds available. Higher interest rates have a direct correlation to lower proceeds. So they're going to get less money the higher the interest rate is.
All right. One of the quotes my clients got for a buyout and a divorce was that he could only get a small lump sum in year 1 and the rest of the proceeds in year 2. Was this just a limit of the plan the lender had?
Yeah, so with the government loans, there's a 60-40 split. So of the amount of money that you qualify for, you can only take 60% during year 1. The other 40% becomes available in 12 months. And the reason behind that is that was one of the safeguards that was put in place in 2015. You had a lot of people that were taking out reverse mortgages, and as quick as the money was coming in, it was going out just as quick. So one of the government safeguards is sort of protecting people from themselves, right? And they make it so you can't use all the money. It sounds like in this circumstance, there was likely a mortgage loan that needed to be paid off first, and that used most of the 60%, resulting in what seemingly would be a little bit of money in year number 1 to the client.
Okay. What are the types of fees paid on these products, and how do they compare to a standard mortgage?
Yeah, so the proprietary non-government loans, the fees are right on par with the traditional mortgage. You have title fees, recordation fees, a loan origination fee that the lender can or maybe won't charge. That's negotiable. On the government loan, the only difference between the fees on a forward mortgage and a reverse mortgage is that MIP, that MIP, that mortgage insurance premium that is paid to FHA, which insures the loan, guarantees the loan, and guarantees the non-recourse element.
All right. We've got a lot of questions here. I'm getting over
a lot of questions. I love it.
What if a client is not certain they will remain in the home? They just don't know if they will stay or sell in 10 years.
I mean, look, our intention is just to best advise them. Nobody's sure, right? We're asking a question of how long you're looking to live in the home. Well, circumstances change, but we want to make sure that we're doing our due diligence. If somebody clearly says, I'm looking to move in a year, look, a reverse mortgage is just simply not the most viable option. But yeah, they can move whenever they want. No different than a forward mortgage, right? If they move, they sell the home. Through the proceeds of the sale, the loan gets paid off, and the rest of that equity is theirs to keep.
All right, let's see if I can get this. If a plan is to begin an income stream 10 years after origination, the pool of cash, which can be drawn down, grows at 6% a year. Does that growth aspect end once withdrawals begin?
So the growth on the line of credit, the line of credit growth is on the unused portion of the line of credit. So a lot of people right now that don't need money are setting up a reverse mortgage line of credit as a standby line of credit. They're setting it up. They're parking it in reserve. They don't need it right now. Maybe they touch it. Maybe they don't. The growth rate is the rate of growth is on all of that money. When they start to take distributions from that line of credit, it's just a less overall line of credit that is growing. So there's going to be a little bit less growth over time. But the growth rate is always 0.5% over the current interest rate.
All right. Can a reverse mortgage be used to refinance an existing mortgage?
Absolutely. Yeah, all the time. To pay off and replace an existing mortgage, thereby eliminating that mandatory mortgage payment on the current traditional mortgage. Absolutely.
Perfect. Specific to one state, where can people find out if the private loans are available?
Yeah, just reach out to me. You can email me at reverse@primeres.com. That's reverse@primeres.com. I'll shoot you over a list of all the approved states for the proprietary loans.
All right. Are the rates typically fixed or do they adjust over time? Got a couple questions about that.
Both. On the proprietary, most of those loans are fixed. There are variable options. Now, the interest rates on the proprietary loans are a wee bit higher, about a point or two higher than a traditional reverse mortgage, a HECM loan. And that's because there's no mortgage insurance premium, right? So the way for it, basically the insurance premium is kind of baked into the rate on the proprietary loans. On the, sorry, I'm reading, and what was can you shoot me that question again, Marcina?
Yes. Just, are the rates typically fixed or do they adjust over time?
Got it. On the HECM loans, the government reverse mortgage loans, most of those loans are going to be variable, particularly when you start to customize. On a fixed rate reverse mortgage loan, the only option is to take a lump sum. When we get into the customization, the tailoring the plan, those are all adjustable rate loans.
Why would a client use a HELOC if a reverse mortgage LOC pays an interest rate?
Lack of education. Simple as that.
All right. Where do you see average appraisal values come out? A client whose house is valued by Zillow at 1.1 million, realtor gives an estimate of 1.8, and the city tax value is based on 805K value. What might a value be for a reverse mortgage that the client could take 50% of?
Yeah, so these valuation websites and models out there, they're so unpredictable, particularly in today's market. Their algorithms are just not, they're just not great right now because of the fluid nature of the housing market. Look, we're going to order an appraisal. If there's going to be an independent third-party appraisal. We have no say who that appraiser is. It's placed through a third-party agency. There's no communication between us and the appraiser. It's completely independent. The appraisers are going to go out, do a full inspection of the home, interior and exterior. They're going to compare all the comps in the neighborhood to the best of their ability, and they're going to put the best value that they know how to in the appraisal report and send it back to us. And that there is the value that's going to be used.
What criteria do you use to determine when or why a private vendor makes more sense than the government HECM?
Yeah, I mean, we have some software that we use, which gives us an apples to apples side-by-side comparison. So then we will chart that with the client. We're going to sit down with the client. We're going to look side by side. Here's the benefits of doing it this way. Here's the benefits of doing it that way. And we're going to let them, again, be empowered to make the decision as to which product is best for them.
Awesome. And then we got a couple asking if you help clients in all states, and if not, which states?
Yeah, so we are licensed in every state except for New York, and we can't do reverse mortgage loans in Massachusetts, but we are able to do reverse mortgages in 48 of the 50 states. And I see some chatter about the best way to reach me. So it is reverse@prime, PRIME, res.com, reverse@primeres.com. And here's a challenge for everybody on this call today. Connect with me on LinkedIn. Shoot me a friend request on Facebook. Let's connect on social media. We try to publish a lot of content. We're constantly trying to innovate and be sort of that market leader that really brings to the financial community all of these different solutions and resources for your clients. So I would love to connect with you on LinkedIn. LinkedIn is where I've met so many of you already. I believe Nancy and I met on LinkedIn. A lot of my CLTC brothers and sisters met them on LinkedIn as well. It's a great resource. If you're not on there, get on there. Highly recommend it. But connect with me. I want to see 50 LinkedIn requests by the time we get off here today, please.
All right. Stephen, thank you so much for joining us today and also being our MC for the day. You guys will see Stephen again in our next sessions today. But yeah, I guess that's it. Stephen, thanks for joining us. Everybody, thanks for coming. Stephen, any last minute words? Always a pleasure to work with IDFA. It's a great partnership we have. Going on 3 years now, I believe, of being partners with IDA. So I'm grateful, I'm appreciative, I'm grateful and appreciative for everybody on here today, and I will see you pretty soon.